Welcome back to Primary Source China Investments. This week we start a new season. We're on season 5. Peng Guo and I are here to talk, and this week we're talking a little bit about the data that came out of China and try to put it into some context, and stay with us to the end to discuss what's probably going to happen going forward. So a few data points came out over the last 10 days, the first of which was China export data, and the headline was bad, down year over year 7.5%. Imports were also down 4.5%. So looking at this chart, there should be no surprise, though. The headline got a lot of attention, but you see this import and export has been decreasing for the past year or so. Actually, this is a 2-year chart, so you've been decreasing for 2 years. Moody's pinned it on weaker global demand, but this is clearly a trend. With exports falling more than imports, China's trade surplus also narrowed. So, Peng Guo, where do you see this trade? What do you hear about this trade? What are your thoughts about what's happening with exports and imports from China's side?
I think this is a really big part for the China side, and right now everybody really talking about that because the U.S. take the decoupling policy, and it's really affected China. And also, I see the statistical number: U.S. significantly reduced the import from the China. I think that's definitely affected the entire China import and export situation. And also, obviously, we are really in the global recession. A lot of demand for the entire world get reduced. So that definitely affected China. But I also see a lot of the e-commerce from the China. They get merged. They try to deal with the client, overseas client directly, open the international market. So I think right now, China probably rely on the clean energy related area, like the electronic car or something.
That was also a big increase. Big increase in exports for e-vehicles. But we need to say the quiet part out loud. The export-led growth is coming to an end in China. China's got to find domestic consumption. Recall the old GDP formula: government spending, investment, consumption, and trade surplus. If trade is increasing at a decreasing rate, something else has to pick up. And sure, Beijing might stimulate, but debt levels are very high. We've covered it on this program a lot. Investment by corporations is never easy in a declining market. So it's hard to get corporations to spend money. That leaves consumption. This has been a story for many, many years about China consuming. We need to get the consumer to consume more. And that worked. I mean, from 2010 to 2019, consumption as a part of GDP was growing rapidly. And that was a great story. But something fundamentally changed, and that was COVID. Since COVID, consumption as a percentage of GDP has been falling. And if you listen to the well-respected Peterson Group, they're saying that the reason consumption has turned down is not just the availability of goods and the availability to spend money and the lockdown, it's that the social safety net has frayed, and households realize that they have to self-insure against healthcare issues. So that means they want to save more. And we've covered it in the past that savings rate on the mainland is at all-time high. So what's your thoughts about all of that, Peng Guo? I know it's a lot of macroeconomics, but
Yeah, I think overall China controlled the inflation pretty good. And for the May data, the CPI price just increased 0.2% year over the year. And dropped 0.2% month over month. That's good. And also PMI price get dropped 4.6% year over year. The major problem is from the unemployment. So because a lot of the companies, the lack of the income, they start to cut the cost and they trigger tremendous of the unemployment everywhere. That's why the consumption cannot get up. So for the China family, due to the real estate industry, this already make the many families empty the wallet maybe many years ago. So the lack of the consumptions. I saw the data, like the Chinese save like the 10 trillion in the bank.
Yeah.
People just try to save whatever they can. They don't want to spend. And also, another very important thing is U.S. Decoupling policies is trigger tremendous of the political risk and conflict.
Yeah, you bring up a lot of good points there. The geopolitical, you bring up the consumption. Things have changed. There's no doubt about that. And if corporations are not adjusting to that and investors are not adjusting to that, and I'll just end with this, we have plenty of news telling us that global trade has, quote unquote, changed. And these numbers are a confirmation of that. But I suspect that the change is also some of the ways we look at data. Sometimes, COVID exports for China reached a huge level and has been coming off. So it may not necessarily be all bad news, but suffice it to say that I'm firmly in the China for China camp, and only the best global firms will be able to navigate those geopolitics. That's not to say that they're going to be profitable, but they will continue to operate in the mainland. So we land on a similar theme. If you're allocating to China, you should allocate to those large A-share companies that serve Chinese clients. There's no other way to express this. The K-Webs and the MCHIs, those companies that are, again, I'm going to beat them up because the performance has been bad. Those kind of names, I'm not saying those are bad companies. I'm just saying the geopolitical risk is not worth the prospective return on those kind of names that are listed in the US and Hong Kong. It's just better to allocate to A shares.
Yeah, that's right.
Yeah, so that's the theme. Hopefully everybody stayed tuned in. And we're going to leave it there this week for the new season, first show, A5, and we'll see you next week. Thanks.
Thank you.